Why you shouldn't buy the same stocks as Warren Buffett. We all know Warren Buffett is the greatest investor who has ever lived. His track record speaks for itself. He's made billions and billions from finding undervalued companies and holding them for a very long time. Because of his accomplishments, people are apt to buy whatever stocks he's buying for Berkshire Hathaway. But here's why you shouldn't copy what Warren Buffett is buying. Specifically, 3 reasons why copying his investments are not a good idea. If you're so adamant in copying his investments, I strongly suggest just buying stocks in Berkshire Hathaway. Let him do all the work. But we'll see why in this video that may not be such a good idea either. So let me explain 3 big reasons why you shouldn't copy Warren Buffett's portfolio. Reason number 1 is the 13F. The 13F is a requirement by the SEC for big institutional investors to report their financial holdings. Fortunately for you, the 13F is made public online, and many investors do look at these holdings and can see what Buffett has bought or sold. The unfortunate thing about the 13F is that all these big investors are required to file at a max 45 days after the quarter ends. So say the quarter ended on March 31st. Buffett, like many big investors, filed their 13F on May 15th. That means any date from January 1st to March 31st, Buffett could have bought or sold that stock, and you wouldn't know until May 15th. That lag in information is a big reason why following what Buffett is investing in is not a wise idea. It has been said many times, especially in the area of investing, information is the most important commodity on Wall Street. And if you get that information too late, then you're not going to get anywhere. He could have bought a stock at $100 a share, and by the time that information is made public, that stock could have been worth $150 a share. Now, would you buy it for $150 a share? That leads me then to reason number 2, Buffett's method for investing. He's famous for telling anyone who would listen what he looks for in an investment. He invests in companies within his circle of competence, with significant market share, and all that other good stuff. You can YouTube interviews of him talking about the same strategy for the last 50 years. But what he doesn't quite make clear is the price he's willing to pay for any stock. So let's go back to that stock he bought for $100 a share. By the time you've learned that he bought it, it's at $150 a share. Because Buffett doesn't say what price point is considered undervalued, fair valued, or overvalued, you wouldn't know if $150 a share is past the point he would buy in. You know $100 a share is a price he would buy, but is $150 a share too much? When you invest, especially if you're someone who idolizes Warren Buffett, you should know that guessing isn't a viable investment strategy. Reason number 3 is what most people simply ignore, and that's what kind of stocks he's buying. Berkshire Hathaway is a giant company with billions of dollars to invest. Chances are you don't have billions of dollars to invest. Heck, you probably don't have millions of dollars to invest. That's the difference. Buffett can only look at large investments. And if anyone who manages a lot of money knows, the more you manage, the harder it is to get higher returns. In fact, Berkshire Hathaway has lagged the S&P 500 by nearly 40% these last 10 years. Buffett can't simply invest in million-dollar companies anymore. It just makes no sense. It's an inefficient way to allocate capital. But for you, you can look at smaller companies and achieve higher returns. Buffett has been quoted as saying that if he was to manage a smaller amount, he could easily make 50% return per year. In fact, in his early days, when he was investing with mere millions instead of billions, he did have some years where his returns were in excess of 50%. So by simply copying Buffett's investments today, you're leaving money on the table. Your return will, at best, match his billion-dollar investment style, but mostly definitely lag his investment returns, which has been lagging the broad stock market. If you had $50,000 to invest, it's easier to return 50% in a single year compared to someone with a $10 billion investment to return 15% in a single year. The larger your capital, the harder it is to make fantastic returns. Warren Buffett, simply by his history, knows how to pick stocks. But those are his stocks based on the amount of capital he has, based on his investment style, and based on whether he bought or sold such stock. In all likelihood, you don't have the same amount to invest. Your investment style may differ, even slightly from his, and you won't be able to time perfectly the exact date he bought or sold such stock. That's why copying Warren Buffett's portfolio is a bad idea. If you enjoyed this video, please consider dropping a like and subscribing to my channel. As always, take care of your money.